All right, welcome to the deep dive. Today, we're really digging into Lennox International.
Yep.
We're looking at their Q2 2025 results, their strategy, basically trying to understand what's going on with this major HVAC player.
And we're basing this directly on their Q2 earnings call,
Go.
the official release, and the 10Q filing, straight from the horse's mouth, so to speak.
Exactly. So think about it. The system heating or cooling your home, your office, Lennox is often behind it. And how they're doing, especially now, tells us a lot about how big companies can, well, navigate some pretty tricky waters. We'll give you the key stuff, the important takeaways.
You want to get into it?
So first up, Q2 performance. The headline number, revenue, was $1.5 billion. That's up 3% year over year.
Solid. It is solid. But what really jumps out is the profit. Segment profit specifically. It surged 11% to $354 million. And that resulted in a record segment margin, 23.6%.
Wow, 23.6%. That's really high for this industry, isn't it?
Yeah. It's exceptional.
Yeah.
It basically means for every dollar of sales in their core business, they're keeping almost 24 cents as operating profit before certain corporate costs. Very strong.
Okay. And earnings per share.
Also strong. Adjusted diluted EPS, that was up 14% to $7.82.
And cash flow.
Operating cash flow is $87 million. Decent, but maybe not quite as stellar as the profit figures suggest for the quarter itself. Still solid generation, though.
So really strong profit performance. How's the leadership explaining this? What's their story?
The CEO talked about strategic focus and resilience, points to things like cost discipline, making the customer experience better, and differentiating how they go to market. And the CSO echoed that, called them record results, despite, challenges. So the message is, we executed well internally.
Right, controlling what they can control. Which makes sense. It suggests adaptability, good internal execution. But let's talk about those challenges, the external stuff they couldn't control. What were the big headwinds in Q2? Because these things matter, right? They affect contractors, distributors, maybe even you listening.
Oh, yeah. It wasn't easy out there. A big one was soft demand in new construction, both residential and light commercial. Just fewer new buildings going up needing systems. Light commercial HVAC shipments for the whole industry, for example, were down double digits. That's a significant drag.
So fewer new installs needed. Any supply issues compounding that?
Yes, definitely. There was a specific issue with R454B canisters. That's the new lower GWP refrigerant they're transitioning to.
Right, we'll get more into that.
Well, the canisters needed to install systems using it were in short supply across the industry. That apparently hit dealer confidence. Lennox even mentioned it might have caused a partial reversal of some market share they gained last year.
Interesting. And what about just general economic anxiety? Inflation, consumer worries.
That played a big role, too. Yeah. You saw persistent inflation, making customers uncertain.
So people held back.
Exactly. More homeowners chose to repair versus replace, fix the old unit instead of buying new, and those who did buy were maybe trading down to less expensive models.
Makes sense.
And remember, during COVID, people were just happy to get an HVAC company to show up.
Yeah.
Now, they're back to getting multiple quotes. Much more price-sensitive, cautious.
But return to normal, maybe, but a tougher normal for sellers. And then there's the wild card weather. How did that factor in?
Hugely. Lennox said May was very soft. Apparently one of the coldest Mays in like 20 years, anecdotally.
So no one's rushing to buy air conditioners.
Not in May, no. But then things picked up considerably near the end of June and into early July. Why? A heat wave finally hit.
Right. So Mother Nature delayed things, but eventually delivered the demand.
Pretty much, yeah.
Okay, so despite all that soft construction, canister shortages, cautious consumers, weird weather, Lennox clearly has some strategic plays working. Let's dig into those. That R454B transition seems key.
It really is. They were very proactive here. R454B is the low global warming potential refrigerant. In Q2, something like 90% of their relevant product sales used it.
90%, that's a fast switch.
Very fast.
Yeah.
And it wasn't just about meeting regulations down the line. They said the transition actually enhanced the products. It involved replacing roughly 70% of their home comfort, their residential line, and 40% of their building climate, the commercial line.
So new refrigerant, new product lines?
Exactly. And that drove a better product mix, which helped profits. Even with the canister issue impacting the wider industry, they feel this smooth transition deepened trust with their customers.
Being ahead of the curve paid off, it seems. What about external moves, partnerships? I saw mentions of Samsung and Ariston.
Yeah, two important joint ventures. The Samsung one brings in advanced tech, smart things integration for smart homes, but also really crucial products like ductless mini splits and VRF systems.
Yeah.
Variable refrigerant flow. Super efficient systems, especially for commercial buildings where you need different zones heated or cooled. This JV helps Lennox in both residential and commercial. They expect it to add meaningfully to growth in 2026.
Okay, and Ariston, that's water heating, right? Seems like a bit of a different area.
It is, but it's a smart adjacency.
Yeah.
Ariston brings global expertise in heat pump water heaters. Lennox sees a convergence happening between HVAC and water heating trades.
Makes sense. Often the same contractors.
Right. And they said 50% of their dealers already sell water heaters, so it offers that one-stop shop convenience. 2026 is the launch year, but they see real growth potential in 2027, especially since regulations are pushing towards heat pump water heaters by 2029.
So new tech, new partnerships. How are they tying this into just like running the business day to day, improving operations?
They're definitely focused there too. In our commercial segment, Building Climate Solutions, they have this full lifecycle strategy. It's about supporting their big national account customers, not just with the equipment sale, but with installation, service, long-term maintenance. It's more of a partnership model. And it's apparently driving revenue growth and better margins.
So deeper relationships, more recurring revenue.
Exactly. And another initiative is emergency replacement for commercial units. It's gaining steam in pilot markets, 5 or 6 now. It leans on their brand, availability, responsiveness. They see it as a good tailwind for the next couple of years.
And they're even putting commercial products in residential stores.
Yeah, trying to leverage that distribution network more effectively, which ties into broader investments they're making in distribution, better fulfillment, wider availability, easier access through digital tools. They're scaling up digital using data better, expanding smart product lines.
Sounds comprehensive. What about manufacturing? You mentioned the transition caused some bumps earlier.
It did. Q1 saw some manufacturing inefficiencies tied to that A2L refrigerant transition that's part of the R454B shift. But factory productivity apparently improved quite a bit in Q2, especially on the commercial side, as their new facility in Mexico gets closer to being fully ramped up.
Okay, so it feels like they're building this whole ecosystem. New refrigerants, smart tech, water heating, full service. It makes you wonder, how might all this change your own interactions with climate systems down the road?
Good question. More integrated, maybe smarter, potentially more service-oriented.
All right, let's pivot to the bottom line then. Given all these moves, the challenges, the strategies, what's their financial outlook? Sounds like they're feeling pretty good.
They definitely are. Raising guidance mid-year is usually a strong signal. They bumped up their adjusted EPS forecast for the full year to $24.25. That's up quite a bit from before.
And revenue.
They increased the revenue growth forecast too, now expecting around 3% growth for the year, up from 2%.
Okay, what about volume? Because we talked about the soft market.
Right. This is interesting. They now expect the full-year sales volume decline to be only 6%. Previously, they were guiding for a 9% decline. So they see volumes holding up better than they initially thought.
That's a significant improvement. How are they managing the cost side to support that improved outlook? You mentioned tariffs earlier.
Yeah, they seem to be managing costs very effectively. The benefit they expect from price and mix combined is now 9% for the year, slightly lower than before. Partly because material costs and tariff inflation aren't quite as high as they first feared.
Okay.
And crucially, overall cost inflation is now expected to increase their total costs by only 6% for the year. That's down from a 9% forecast earlier.
A big drop. What drove that?
Mostly really effective tariff mitigation. Remember, they initially thought tariffs might hit them for $250 million.
Yeah.
They've gotten that down to less than half through things like switching suppliers and some tariff rates actually changing. They even pulled back a chunk of the tariff surcharge they were passing on.
Wow. Nimble response?
Very. Though they are still watching potential future tariffs. South Korea, some August deadlines, rules around North American production. It's an ongoing thing.
Always something. What about inventory? Were they stuck with a lot of product given the slow start to summer?
They did build up some inventory. They called it temporary inventory investments, partly to support that smooth R454B transition, partly for launching the new Samsung products, and also for that commercial emergency replacement push. So yes, levels were higher, also because summer started slowly, but they expect that to normalize in the second half, and it's apparently baked into their free cash flow guidance.
Which is still pretty strong.
Yeah, full-year free cash flow guidance remains $650 million to $800 million. So they're confident they can manage that inventory down.
Okay. And competitively, they had a huge market share gain last year, right? How do they see that playing out now?
Right, 2024 was their biggest share gain ever in residential. They expect to give some of that back in 2025, quite a bit, or partially was the phrasing, partly because of those R454B canister shortages hitting dealer confidence, maybe pushing some consumers to repair instead of replace with the Lennox unit specifically.
Yeah.
But even giving some back, they still expect to end 2025 with a very healthy and large market share. So maybe not peak share, but still very strong.
Got it. And how are they using all this cash they're generating, giving back to shareholders?
Definitely. They've been buying back stock $300 million worth so far in 2025. And they got authorization for another $1 billion in repurchases back in May.
Okay.
Plus, they boosted their quarterly dividend by 15% in May. Clear signals of confidence in earnings and cash flow.
So share buybacks, dividend hikes, anything else on the financial radar?
One more thing to note, there's a new federal tax law called the One Big Beautiful Bill Act, signed July 4th. Lennox mentioned they're still evaluating the potential impact, so TBD on that one.
Okay, something to keep an eye on. So, wrapping it up, this deep dive really shows a company balancing growth and smart financial management in a, well, let's call it an interesting economic climate.
Yeah, absolutely.
Their confidence seems pretty high, based on that raised guidance and the strategic moves they're making.
We've definitely seen a company here that's not just, reacting to challenges. They seem to be actively trying to shape their own future. Product transitions, these JVs, the operational stuff. The Q2 results really highlight how much disciplined execution can matter, even when the overall market is a bit choppy.
So, here's a final thought for you listening. As companies like Lennox push forward with smarter tech, greener refrigerants, even merging HVAC with things like water heating, think about how this increasing complexity and interconnectedness in our homes and buildings might change what you expect. What will comfort, efficiency, and maintenance look like in, say, 10 years? What role do you see these integrated systems playing?
Yeah, how smart does your climate control need to be? Interesting stuff to ponder.